Hello everyone, my name is Miniseti. I hope you all are staying healthy. Today we are going to talk about meaning, objectives and instruments of monetary policy. What is monetary policy? Monetary policy is a process by which central bank of the country control money supply, availability of money, cost of money such as interest rate in order to maintain stability and growth in economy. Monetary policy is a process by which central bank of the country control money supply, availability of money, cost of money such as interest rate in order to maintain stability and growth in economy. As we all know, increase and decrease in money supply creates so many fluctuation in economy. That's why central bank of the country control money supply so that stability and growth can be maintained in economy. Now we are going to talk about objectives of monetary policy. First objective of monetary policy is price stability. As money supply increase, demand will also increase because now people have more money in hand. That's why they are creating more demand. As demand increase, prices also increase. If prices are continuous increasing, it will create inflation in economy. During this time period, to control inflation, central bank through monetary policy reduce money supply. As money supply reduce, demand reduce and prices also reduce. Second objective is economic growth. Through monetary policy, central bank of the country reduce interest rate. As interest rate reduce, people are taking more money from banks for investment purpose. As a result, investment increase. As investment increase, income and output also increase. As a result, our economy is growing. Next objective is reduces unemployment. Through monetary policy, central bank of the country increase money supply. As money supply increase, business activities also increase. People are starting their new business. They are expanding their existing business. As a result, they are creating new jobs in market and unemployment will fall. Next objective is reduction in economic inequalities. Economic inequality is the gap between rich and poor. Through monetary policy, central bank of the country give credit to weaker section of society as lower interest rate so that they can start their small business and gap between rich and poor can be reduced. Now we will say instruments of monetary policy. Instruments of monetary policy are divided into two parts: quantitative instruments and qualitative instruments. Quantitative instruments include cash reserve ratio, statutory liquidity ratio, repo rate, reverse repo rate, bank rate and open market operation. And qualitative instruments include marginal requirement, rationing of credit, moral suasion and direct action. One by one we discuss about each. Firstly, we are going to talk about quantitative instrument. First quantitative instrument is cash reserve ratio. In short, we consider CRR. So what is CRR? CRR is some percentage of total deposit of banks that they need to keep with central bank in form of cash only. CRR is some percentage of banks total deposit that they need to keep with central bank in form of cash only. For example, total deposit of commercial bank is 1 crore and they need to keep 5% of 1 crore as a cash with central bank, and CRR is decided by central bank. If central bank want to reduce money supply in market, then it will increase the rate of CRR. If CRR increase, means bank has to keep more money with the central bank and they have a less amount to give loans to public. When banks will give less loans to public, money supply will reduce in the market. On the other hand, if central bank want to increase money supply, it will reduce CRR. Now banks has to keep less cash with central bank. They have more fund to give loans to public, so bank will raise more loans to public. As a result, money supply will increase in the market. Now we are going to talk about next quantitative instrument. It will call statutory liquidity ratio. In short, we can say the SLR. So what is SLR? SLR is minimum percentage of deposit that commercial bank has to maintain in form of cash, gold and securities. SLR is minimum percentage of deposit that commercial bank has to maintain in form of cash, gold and security. Means these cash, gold and security commercial bank cannot use for credit purpose. They have to keep with themselves. Don't confuse between CRR and SLR. In case of CRR, commercial bank has to keep cash with central bank, but in case of SLR, commercial bank has to keep gold, securities and cash with themselves, not with central bank. Second difference, in case of CRR, we include cash only, but in case of SLR, we include cash, gold and security. Same way as we discussed in CRR, SLR also decided by central bank. If central bank want to reduce money supply, supply, it will increase rate of SLR. On the other hand, if a central bank want to increase money supply, it will reduce the rate of SLR. Now we are going to talk about next quantitative instrument. It will call repo rate. So what is repo rate? Repo rate is the rate at which central bank of the country lends money to commercial bank. Repo rate is the rate at which central bank of the country lends money to commercial bank. Sometimes commercial bank borrow money from central bank. In return, they has to pay some interest rate, and this interest rate is called repo rate. And second most important, while lending money to commercial bank, central bank keeps some government security as a mortgage. In case commercial bank not return their money, then it can easily sell this government security and recover its money. If central bank want to reduce money supply, it will increase repo rate, because when repo rate increase, banks will increase interest rate because they are paying higher repo rate to central bank. As interest rate increase, people will take less loan from bank. As a result, money supply will reduce in the market. On the other hand, if central bank want to increase money supply, it will reduce repo rate. Now we are going to talk about next quantitative instrument. It will call reverse repo rate. So what is reverse repo rate? Reverse repo rate is the rate at which commercial bank earn interest when they keep their surplus money with central bank. Reverse repo rate is the rate at which commercial bank earn interest when they keep their surplus money with central bank. Sometimes commercial bank have a extra money and they keep this extra money with central bank. In return, central bank pay them some interest rate. It will call reverse repo rate. Or we can say sometimes central bank borrow money from commercial bank. In return, it pay interest rate to commercial bank. It will call reverse repo rate. When central bank want to reduce money supply, it will increase reverse repo rate. When reverse repo rate increase, banks keep more money with the central bank because it is very safe and secure as compared to giving loans to people. So when banks keep more money with central bank, they have a less fund to give loans to public. As a result, they will give less loans to public and money supply will reduce in the market. Now we are going to talk about next quantitative instrument. It will call bank rate. Bank rate is the interest rate that is charged by central bank while giving money to commercial bank. Bank rate is the interest rate that is charged by central bank while giving money to commercial bank. Sometimes commercial bank borrow money from central bank. In return, they have to pay some interest rate. It will call bank rate. Don't confuse between repo rate and bank rate. In case of repo rate, while taking loan from central bank, commercial bank has to keep some government security as a mortgage. But in case of bank rate, commercial bank need not to keep any government security. And same way as we study in repo rate, if central bank want to reduce money supply, it will increase bank rate. On the other hand, if central bank want to increase money supply, it will reduce bank rate. Now we are going to talk about next quantitative instrument. It will call open market operation. Open market operation means buying and selling government securities by central bank of the country in order to control money supply. Open market operation means buying and selling government securities by central bank of the country in order to control money supply. For example, if central bank want to increase money supply, it start buying security from the market. When central bank buying security from the market, in return paying money to market means in return giving money to market. As a result, market has a more money and money supply will increase. On the other hand, central bank want to reduce money supply from the market, it starts selling security in the market. When central bank selling security in the market means money from the market is coming to central bank. As a result, market has a less money, money supply will reduce. Now we are going to talk about qualitative instrument. First qualitative instrument is margin requirement. So what is margin requirement? Margin requirement is difference between current value of security offered for loans and value of loans granted. Margin requirement is difference between current value of security offered for loan and value of loans granted. For example, someone want to take a loan and he keep his home as a mortgage, or we can say keep his home as a security, and value of his home is 1 crore, but bank giving loan of 80 lakh. Difference between 1 crore and 80 lakh is 20 lakh. This 20 lakh is called margin requirement. If central bank want to reduce money supply, it will increase margin requirement. For example, if you want to take a loan of 1 lakh, then you have to keep the security of 2 lakh. As central bank increase margin requirement, people will take less loan from bank. As a result, money supply will reduce from the market. Now we are going to talk about next qualitative instrument. It will be called rationing of credit. Rationing of credit means set fixed limit for loans for different sector so that no sector is neglected. Rationing of credit means set fixed limit for loans for different sectors so that no sector is neglected. In rationing of credit, a central bank set maximum limit and commercial bank cannot give loans to particular sector beyond this limit. For example, in order to control money supply, central bank set maximum limit. Commercial bank gives 60% loan to weaker section and 40% loans to higher class. By doing this, a particular section will go only limited amount of money and we can control money supply. Now we are going to talk about next qualitative method. It's called moral suasion. Under moral suasion, central bank simply advise, request or convince commercial bank to control money supply. For example, money supply is continue increasing. During this time period, central bank simply says to commercial bank, don't give more loans to public, please cooperate with us. Next method is direct action. If commercial bank do not cooperate with central bank and it is giving continue loans to public, then central bank will take direct action against commercial bank. For example, central bank will reject any application of commercial bank and put any other restriction on commercial bank. This is all about meaning, objective and instruments of monetary policy. I think you got it, and thank you so much for watching this video. Bye, take care.